Good afternoon. Welcome to the TheoTrade afternoon video. I am Blake Young. Today is June 20th, 2024, and we are seeing a return of the flight to safety as tech tanks. Now, I'm doing this video a little bit before the close today, and we've still got a couple of hours, but as you can see in the ES futures, the S&P 500 has created a widening pattern after putting moves into the highest high. So we reached 52-week highs today in the S&P before selling off and creating a widening pattern. But it's more dramatic in the tech stocks. As you can see in the NASDAQ, we've already traded in a range of 375 points. That means we have already traded in a 1.5% range, more than that. And we are selling off to the area where we rolled the contracts, which means that we could have seen the rally on Monday due to the contract roll and adjusting positions, buying longer-term dated futures and closing out existing positions at this previous resistance area, the 52-week high, on a gap. And so if we get through this level, about, let's call it 19,950, then that top was a fake out breakout. That's a reversal pattern already, and we're seeing this sell-off occur, and we are going to be higher than normal volume. When comparing the sectors, the major 11 sectors versus the S&P 500, and comparing over the last quarter, this is 3 months worth of time, you're going to see a couple of things. One is not only that we have the trends that have been established and continue, but a sudden acceleration in some and a drop in others. And I'm going to highlight this from the 3-month time period as well as just the 1 day. So up here at the top, what was in a pullback and it now is bouncing while the tech sector drops is utilities. That red line right there is utilities. What was continuing to advance was technology, and technology has reversed from 10.5% to 8.8% in 1 day. So we are seeing quite a reversal in tech here, but a continuation of recovery of utilities and the defensive sector. All the way down here at the bottom, you can see this sharp reversal in energy, and I think that's being driven primarily because crude has bounced and returned all the way above $80 a share, or $80 a barrel again. And as we're looking at these, we can see some of the upward sloping ones. Financials over here, communications are up a little bit, but pretty much the tech sector is down and everything else is flat. If we look at the sectors as a percentage on today, and you'll see this is my favorite watch list, is I compare all the major sectors. I've got the NASDAQ in here, the NASDAQ futures and the S&P futures, and I also have copper, gold, and crude. And so as we look at this, crude has held up the market. Energy is all the way up here, 2.2%, and it's a solid day for energy. Copper, though, is up 1.78. Gold is up 1%. Crude is up 0.74. And so what we're seeing is inflation exists. We still see inflation is holding on, hanging on. Copper, gold, crude are up, and therefore energy as well. And again, the weakest is the tech sector, down 1.7%, while energy is up. This is a divergence and could be the indication again that we've reached the top for technology. And we're looking at who's next in line. Utilities. Utilities are back. Basic materials because energy, gold, and crude is climbing. And then we go to healthcare. So healthcare, utilities, we are seeing that flight back to safety. And you can see on the Market Watch Visualize tab, everything is bright red except for AMD. AMD is up 4%, but everything else is bright red. You look over here and you look at energy. Obviously, that one's up for today, but I'm more interested in what we're seeing in utilities and healthcare. Utilities, NextEra is just dominant. The rest of these are pretty flat. So we are being lifted by one primary instrument in utilities, which I like NextEra. I've always liked it. And Dominion's doing okay. Alliance doing great for the day, but is a little bit smaller stock. So I still want to be looking for opportunities in utilities, but I may just go with XLU overall rather than trying to chase down NEE. With oil prices up, that could mean an increased production of oil, which means we could see higher supply of natural gas, which should keep utilities outperforming. As we look at the healthcare sector, you can see Gilead is up almost 9%, driving that market primarily. But Johnson & Johnson, Merck, Abbott, and Amgen are all doing well as in the same time frame. Again, because it's one that's kind of holding up the whole sector overall, I will look at this from the big perspective of XLV. So let's take a look at utilities. Nice little bounce there. A gap down, close up, and fill the gap, close inside the gap. That's an exhaustion gap turning into a bounce. We had a follow through today with making a higher high, higher low, and clearing out the sellers here. It's not a super strong end of day move, but it is still a bounce. And I think this is a great time to look at picking up positions in utilities, XLU. Maybe even selling a put to get in there. XLV, the healthcare sector, you can see is near the highs. And I like the candlestick today because the gap down, close up, filled the gap and is appearing to fill all the gaps and pushing higher to these levels. We might be looking at pushing through 147, or you can wait till it gets to a 52-week high. But overall, again, another opportunity to sell premium and be okay with being assigned. If we look at XLK, is XLK bearish enough today that we feel like we could sell premium against XLK as well? And the reason why I keep going back to selling premium is we know volatility is high right now in this very moment with the market pulling back. There's a lot of uncertainty and that flight to safety into utilities and healthcare and even consumer staples. As we're looking at this pullback and the engulfing candle, the widening pattern after reaching a 52-week high in technology, 52-week high in the S&P, a 52-week high in the NASDAQ, this pullback is significant. And if we see the volume hold up and we see us close down near this low, and if we wipe out Monday's candle, for me, that is enough to take a bearish position, just flat out bearish position. But if I'm looking at this and saying we may have put in the high, what if we look at the options? Going to the option page, pulling up XLK, scrolling way down to the bottom, you're going to see that our current implied volatility percentile is 96. So this is the most expensive the options have been in the last 20 or 52 weeks. Last 52 weeks, this is the highest the price has been. So as we're looking at that, that's telling us we can get away with selling premium. I don't want to just sell a naked call right here. I would say let's do it as a spread for the next month. If we look at the next month and sell just above where we're at, let's go up to this delta of 35 at the 235. And if I sell the 235 strike and buy the 240 strike, just a simple short call vertical, we're getting paid $1.33. Now, I want to see 25 cents per dollar wide. This is $5 wide, so normally I'd want to see $1.25. So $1.25, we're at 135. We're getting paid more than what I expect, and it's a delta of 35. I'm not doing the delta of 40 or 42 like we've had to do in the past. This is a reasonable and controlled risk trade. And that means as long as we stay below 240, we won't have the max loss. If we stay below 235, which means we could bounce $6, 3 times what we fell today, this is safe. And so today's big sell-off, we could bounce and go 3 times the opposite direction and we still keep all of it. We could bounce and go as high as $11. In other words, almost 5 times this before we're really threatened on the top side. So I like this short call vertical at 235 by 240 for the July option. Going back to utilities, and looking at our option premium, we are not at the highest level. In fact, we're fairly low. This is a conservative play. And as much as I want to sell a vertical, I think if you want to get into the trade, you could get away with selling just a put. Just sell a put against it at the current price. Say I'm willing to buy into here, because if I buy into here and I end up owning the stock, I'll also collect 3% dividend yield while diversifying myself across all utilities, not just playing Nextera. If you like Nextera or Dominion, as those are the ones that have outperformed as of today, what I will do is I will edit this and put on that return on risk. And it'll tell you that by selling at the money, we're closest to 72.50, 71.96, they're going to pay us 2.8% for being willing to buy it at 72.50. And so by the time we get assigned, we give back a little bit because we're buying at higher than the current price. But that's about 2.5%. That's my benchmark. And part of the reason why I even look at that is because Nextera is at the 100th percentile for implied volatility. Dominion, you could look at their implied volatility down here at the bottom. Low implied volatility. I would just be looking at buying the stock or buying the call on this one if I'm wanting to participate, as the premium they're going to pay is not quite where I want it to be, and I want to participate in that yield if I was going to get into the position. That being said, looking at healthcare, one of the other defensive sectors, it's somewhere in between. We're not seeing low implied volatility like we saw in XLU in the 20s. We're not seeing high like we saw 100% levels in Nextera and XLU, but we scroll down and we can see that we're at about 46%. That is good enough to sell premium into, but not so high that I think we're really in any type of a precarious situation, and we could really take an in-out spread on something like healthcare. As we're looking at healthcare, going back to the charts, healthcare, we talked about the idea that we want to get above this high and create maybe a head and shoulders pattern, or better said, a cup and handle pattern up at the top, or ascending triangle, depending on how you want to look at this. And we could be looking for an $8 to $10 move from where we're at. We could be going to 156 or higher. To trade an in-out type spread, we would go into this, and I say type because I take a different approach on here. I would be looking to buy the 144 near that delta of 70 and paying 320. But of that 320, if I look at the extrinsic value, 108, 109 is extrinsic. So I would want to sell and collect as much of that as I can. I think we will go with the 148, meaning go back and retest the high. We're going to collect almost all of it. We're going to pay $1.09 and we're going to get 92. So I'm going to collect nearly all the time decay out of this position. And if I do that, I've got a $4 widespread and about a 220 option. That would give us close to a 1-to-1. And if we wanted to go with the 147 to get all of our time decay out of it so it doesn't have to move, then we'd be paying about $1.82 for $3 wide. This is just a little bit more expensive than I like to do. I like to be at least 1-to-1, meaning 50% of the spread cost or less. But I do think this is a good opportunity to be looking at adding healthcare into the short-term and long-term positions. And as long as technology continues to sell, that's something we should be paying attention to. The other thing I'd look for confirmation of a flight to safety and avoiding equities is potentially a move back into bonds. You can see that bonds have been making higher highs, higher lows. Today we gapped down and we moved higher. And that just shows me it's an exhaustion gap and we're uncertain. Until we get back above this high, I'm not willing to commit back into bonds. And right now we're just kind of holding in the middle of all this noise. So not quite there yet, not quite the confirmation I want as far as flight to safety as moving into bonds. And so it's going to be flight to safety in specific equities, probably flight into the US dollar. The US dollar has done really well today and away from technology, at least as it sits right now. So that's going to do it for me today. Thanks for watching. Join me again next week and have a fantastic week. We'll see you in the morning.